Today I would like to analyze Xiaomi. This company sells mostly smartphones. They also sell other products as we can see here, and even outdoor gear with the electric scooter. So it's an interesting company. We can see in the 1 year chart we are up 182%, and in the 5 year chart it looks similar. We can see here we did have a comeback, and this look incredible actually, 250% in a short time. So we're going to look about the financial to find out if this company is still a buy in my opinion. The first thing we can recognize about this company is a huge market cap of 876 billion Hong Kong dollar. This equals around 115.8 billion US dollar. So it's already a huge company. The market cap is the current stock price multiplies with the shares outstanding. We can also see we do not have a dividend right now. The first thing we are looking for in the financial foundation is a revenue growth in the last 5 years. We can see here 2020 18% revenue growth, 2021 43%. Then we have a strong decline around 17%, and then we have a strong decline again around 8% in 2023. So overall we still have a good revenue growth, I would say, but it's concerning that they have a revenue decline in 2 years, but it's still a check here. When we take a look at the revenue in 2024, we can also see they have a recovery, they're growing again, the revenue. And this is probably one of the reasons the stock price did increase so much. So the next thing we are looking for is free cash flow growth in the last 5 years. This is very important because the free cash flow can be used for paying dividend, investing in the business, paying the debt, or to buy back their own shares. So it's a very important number and we would like to see that grow. We can see here 2019 around 25 billion. Then we have the 2% increase in 2020. Then we have a strong decline in 2021. Then we have a negative free cash flow actually in 2022. And then we have a strong positive free cash flow with 42 billion in 2023. So overall, we have a growth in the last 5 years. Is a check for me here as well. The next thing we are looking for is free cash flow yield over 4%. This also tells us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued right now. So what we're going to do is we're going to take the free cash flow in 2023, 42.72 billion. And then we're going to divide it with a market cap of 876. And then we're going to get the free cash flow yield. So the free cash flow yield is around 0.0487, which means around 4.87%. So it's over 4%, which is looking good. So it's a check here. But we also have to consider that Chinese companies usually have a high free cash flow yield, and it's not always the reason to buy. So sometimes the Chinese companies are way undervalued. So at this case, maybe it's not even that undervalued considered to be the Chinese company. Now we're going to take a look at the balance sheet. We would like to see the debt to free cash flow ratio under 5. So what does it mean? It means that the company can pay back the debt with the free cash flow in under 5 years. So it's an important number because if a company has too much debt, it could risk to go bankrupt. So what we're going to do is we're going to take the short-term debt here, 7.59, plus the long-term debt, 25.25. And then we're going to divide it with the free cash flow. That is 42.72. Then we're going to get the debt to free cash flow ratio. So the number we get is 0.768. So this means the company can pay back the debt with the free cash flow in under 1 year. It's a very good number. It's a check here. We're also going to take a look at the cash on hand. So we can see here in 2023 they had around 123 billion. Hong Kong dollar cash on hand, which is a great number, is higher than the debt they have and is even higher than the free cash flow they have. So it's a good number, I would say. They can use this money to invest in the business or to pay dividends or to buy back their own shares. Now we would like to see the shares outstanding decrease in the last 5 years. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look here and we can see it looks interesting. The shares outstanding increased 2019, 2020, and 2021. Then 2022 it decreased, and in 2024 it decreased as well. It could mean they did buy back shares in 2024. So it looks interesting, and I think they could buy back more shares, but they can also use this money to invest in the business. I heard they also go now in the electric car business. So of course this takes a lot of money, so it's understandable that they don't buy back a lot of shares right now. So it's not a check here, I would say. I would like to give my conclusion about this company. So let's start with a positive. They have a good revenue growth in the last 5 years, but they also had a revenue decline in some years in a row. So we have to consider that as well. They have a free cash flow growth in the last 5 years, but they also had a negative free cash flow year. So it's not looking incredible good. The free cash flow yield around 4.87% is also good. It's over 4%. But for Chinese companies, it's not looking very undervalued in my opinion right now. The balance sheet is looking really good. They have less debt and a lot of cash on hand. So the last thing would be the valuation. In my eyes, this company did increase already. The stock price did increase around 130% in the last 6 months. And I think it could be overvalued right now. Of course, if they keep growing the business, keep growing the revenue, this company can still look cheap somehow. But of course, we have to consider this is a Chinese company, so they're often undervalued in some way. So for me personally, I would not buy right now because the stock price increased a lot. The company doesn't look so bad. I know they make quite good products, I think, and the financials looking not so bad as well, but I think it can maybe have a better times to buy in this stock.